Welcome to TradeSpoon. My name is Vlad Karpel. I'm CEO and the founder of TradeSpoon, and I'd like to continue our discussion on advanced technical analysis. We talked about the upper studies and the lower studies. We also started talking about chart patterns. We talked about rectangles, we talked about triangles, and now I'd like to turn our attention to flags, another common pattern. So let's take a look. What is a chart pattern? Let's review that. We've covered that in previous session, but if this is your first video, let's quickly go over that. Price patterns are tools for displaying data that reflects investor psychology and sentiment. Price patterns can be used to project future price direction based on the patterns established in the past. Here we will look at the terms like trend, support, and resistance. Most commonly used chart patterns are flags, triangles, and rectangles. So let's talk about flags. A flag is a short-term pattern that forms over a few days or weeks, especially after the earnings announcement. It can be either bullish or bearish. However, flag patterns are usually viewed as continuation patterns or slight pause in the current trend. Anytime there is a binary event, you can see that the flag is being established prior to binary event. The rallies are referred to as flag poles, and rally usually occurs after the binary event, such as earnings. So let's talk about the setup, pattern construction. Initial strong short-term price movement, sideways price movements, parallel support and resistance lines that you can see on your screen. You see the red line, that's your overhead resistance. And you see the green line, that's your support. And you see decreased value. You see from April, going from March 29th, going into April 12th, you see a rally to the upside. Then you see buyers taking the profits off the table. When the buyers are taking profits off the table, especially before the earnings announcement, you see on a lower volume, you see that pole of the flag. You see how the red and green lines are parallel and they're moving down into April 12th and up April 19th. The entry is a breakout against direction of previous trend. So once on April 26 you see a breakout of the overhead resistance, this is your entry point, and it's happened on increased volume. So again, this is a continuation pattern, and also as flag you also have pennants, and you can see an example of a pennant on your screen. And again, on July 6th, on July 7th, you see this violent move to the upside after the short-term consolidation phase, and you have a continuation of the upward momentum. So right around at $34, $34.25, this is your entry point. You know that there is an earnings announcement, buyers are taking the profits off the table, and then there's a continuation pattern going into the next earnings cycle. Conclusion: it is always important to be aware of the dominant trend in the market, and price patterns can give you a glimpse of what the stock future may be hold for you. The price patterns are not infallible, so you got to make sure that you not only rely on chart patterns, but if you look at the systematic analysis, like the one that we have at TradeSpoon, where we rank stocks and tell you which stocks you should trade on a daily basis and what are the short-term support and resistance levels are. If you take that information and overlay that with chart patterns, it can really improve the odds in your favor. Again, visit TradeSpoon for a free trial. You can also participate in our weekly webinars. And as always, follow us on social media, tradespoon.com/video, and we have a Facebook and a Twitter account. Thank you very much.